So this scenario is common for a lot of developers. Your construction lender has come back with an offer letter that requires you to put more cash in than you would have anticipated. Cash you just don't have. Now before you go to seek money from friends or family, have that awkward conversation, or you might even have a business partner involved, you don't want to have to ask them for more money, you do have options. Hey everyone, Doug Cotton here, your property finance specialist, where I talk everything finance related for property investors and developers. Make sure to give this video a thumbs up if you find the content useful or helpful, or even hit that subscribe button if you want to be notified of future videos. Let's get into it. Now there's a number of reasons why you might need more funds, those being you might have partnered with someone that happens to have deeper pockets than you and you need to level the playing field, you just don't have the cash to do that. Or you've received back a few builders quotes which are higher than expected, requiring you to put more cash in, or your construction lender said the property or the project valued, the numbers have come in lower than what you would have expected, requiring you to put more cash in. Now whatever the scenario, there are options. So guys, what I'm going to go over today can be known as, or referred commonly to as, structured finance. So structured finance is essentially a more sophisticated form of lending, offered mostly by alternative lenders or private investors. The types of agreements under structured finance that I typically arrange for include mezzanine loans and preferred equity agreements. I'll also talk to you today about a third option, joint venture agreements. So often referred to as a top-up loan, a mezzanine loan is essentially a second loan on top of your construction loan, which is secured via a second mortgage over the project. It's usually required for developers to help fill the gap between what you're required to contribute towards a project and what you have available. Now when I say what's required to contribute, I mean the difference between your total development costs and what your first mortgage construction lender is prepared to extend you towards the project. Unlike a preferred equity agreement, which is a private arrangement, it's a loan made between a borrower and a lender and is subject to terms and conditions, interest rate, establishment fees and other fees. It's very common for the mezzanine lender to impose loan conditions which mirror that of the first mortgage construction lender. So your interest rate will normally be higher than a construction lender, and that's because of the risk associated with being subordinated on title with the mortgage, so being a second mortgagee sitting behind the first mortgagee. So let's talk about preferred equity agreements or preferred equity investment agreements. So a preferred equity investment agreement is a private arrangement made between a developer and a private investor, whereby the investor contributes so much cash in exchange for either a share of profit from the development or a set interest rate or a set return payable either through interest or dividends. The investor won't take a registered mortgage over the property, but instead a shareholding in the project, as well as require the developer to sign a mortgage that would only be registered on title once the construction lender is paid back, or if the developer fails to meet its obligations under the agreement between the two parties. If the investor agrees to a set interest rate rather than a share of profit, then the rate will likely be higher than a mezzanine loan. And that's because the investor has no solid collateral to their position. There's no registered mortgage on title. They've essentially taken an equity position or an unsecured position. Now the name preferred equity infers that the investor will be paid back his or her funds before the developer's profits and after the construction lender. So why would a developer seek an investor out instead of just borrowing the money at a lower interest rate? Well, they probably have looked to get a mezzanine loan. However, they would have needed agreement from their construction lender first. See, your more traditional construction lenders such as the banks and second tier lenders are getting more and more reluctant these days to allow a second mortgagee to sit behind them on title, unless a lengthy list of conditions is met first, such as the developer having to contribute 10% of their own cash and a high level of pre-sales. They also need to know the mezzanine lender quite well and determine whether they have deep enough pockets to help complete the project if there's ever a problem. So let's talk about joint venture agreements. So a joint venture or a JV agreement is essentially a partnership between two parties, be it individuals or organisations with the goal of developing property together. So the agreement provides the framework for the two parties to record in writing the details of an arrangement while maintaining separate entities. Common scenarios in which two parties have been brought together could include: you might have a landowner who owns a block of land which is quite developable but lacks the experience, and a developer who lacks the equity but is abundant in experience. Or you might have a developer who lacks the equity, might have a block of land that bought under an option and progressed the property substantially through the design stage. You might have them partner with a builder who can absorb the construction costs, requiring less cash to go in from a lender's perspective. Then you just have two like-minded developers who feel this would be synergy to developing property together. One might bring a certain set of skills and the other another set, such as one might have the actual building experience, the other might have the marketing experience. So the JV agreement defines the terms and conditions under which the two parties record their interest and forms the basis of the collaboration. It also provides the legal protection should there be a misunderstanding or if the other party fails to meet its obligations under the agreement. So guys, if you'd like to know more about what options you have in terms of the banks and non-bank lenders for your project, then I recommend you click the link on screen now. And so here I go into more detail about the differences between your more traditional and non-traditional forms of lending. So guys, if you have any questions, please include them in the comment section below and I'll endeavour to get back to you as soon as I can. And I'll see you at the next one.